All right, we've only got a few minutes, so we're going to hustle to Kennedy's question from Little Rock, longtime listener, but it's my first time writing in. I love your show. This might be a hot take. Do you think target date funds get too conservative too soon? Do most pivot out of them as they reach a certain level? Thanks, Kennedy, for the question. Let's start by answering for people listening, what are target date funds? They are most popular now in employer plans. They have become, and many times, the only option even available inside of some plans, but they basically are funds available in your 401k or employer-sponsored plan, and the target date part of that is in reference to the name of the fund. There's usually a year on it, like 2030, 2040, 2060, a target date or a target year in the future, and many people are encouraged to choose the date or the year in which they expect to retire and place their investments inside of that target date fund. Now, Janet Kennedy asked, do they get too conservative too soon? They are built to be on a gliding scale where basically the allocation, it becomes mostly equity in the farther out date that you choose,
right,
and gradually becoming more bond heavy or fixed income heavy in the allocation as the date gets nearer.
So we would tend to agree with you that it has often been our experience that, yes, they do get too conservative too soon, but I also want to be careful about us considering bonds as conservative. They do get that stronger allocation, but Scott, we've seen recently, in recent years, that bonds were not necessarily a conservative place to be, a safe place to be, because as interest rates went up, those bond prices went down, and so we saw people actually losing value in what they thought was a safe place to be. So be cautious about that. The other thing that I would encourage anybody, as you get closer and closer to retirement, to think about is that retirement is not a stop sign when it comes to your investments. There is a great need for you to remember that you're going to have multiple decades in all likelihood in retirement. So you need to treat some of this still as long-term money. And that is really why we believe that they get a little bit too conservative with the overall allocation too soon for us.
Yeah, that's a great point, because if your entire life savings is in your 401k, what you're going to live on in retirement, and it becomes too conservative, there may not be enough of a growth component to your assets. And to Janet's point, retirement is not a stop sign. You still have to believe in equities as part of your overall investment strategy, even in retirement. And why? The main reason is because you're going to have a way to raise your income over a long period of time. We've seen inflation take a bite out of our buying power over the last 2 years. It won't be that high all the way through your retirement, but it's going to be there. Things are going to cost more, and you're going to have a way to account for that by raising your income. And equities, along with real estate, are the only two asset classes that historically have outpaced inflation.